Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Michael Mauboussin, one of the greatest of all time in the fields of investing and corporate finance. Thank you, Michael, for joining me on our Fortuna Advisors podcast, Create More Value.
Greg, awesome to be with you today. Appreciate it.
So Michael J. Mauboussin is Head of Consilient Research at Counterpoint Global within Morgan Stanley Investment Management. Previously, he was Director of Research at Blue Mountain Capital, Head of Global Financial Strategies at Credit Suisse, and Chief Investment Strategist at Legg Mason Capital Management. He is also the author of 4 books, including More Than You Know, Finding Financial Wisdom in Unconventional Places, named in the 100 Best Books of All Time by 800 CEO Read. Michael has been an adjunct professor of finance at Columbia Business School since 1993 and received the Dean's Award for Teaching Excellence in 2009 and 2016. He is also Chairman Emeritus of the Board of Trustees of the Santa Fe Institute, a leading center for multidisciplinary research in complex systems theory. So it's not every day I get to question one of the leading minds in investing in corporate finance, and I have about 1,000 questions I'd ask if we had unlimited time. But as we do have limitations, I'll stick to a few key themes related to our podcast name, Create More Value. In October 2023, you published a piece on total shareholder return, or TSR. Could you please share some of the findings of what drives TSR and how to identify what you call value traps?
Yes, thanks, Greg. And, I got to say, this is sometimes I write reports and the ideas keep banging around in my mind. And it's interesting you picked this report because this is one of those specific examples. Let me give you a little bit of a backdrop, sort of the backstory. I was sitting in August of 2023. I was sitting in on Tano Santos, who runs the Howard Center at Columbia Business School. He does a 1-week session called Modern Value Investing. So I'm just sitting in there just as a student, like listening to what he was saying. And he had a little section on value traps, and you alluded to value traps, So I was like, we need to go back and do this. So let's get into this, right? And so what we talked about was total shareholder return, which is really the capital accumulation rate, right? And by the way, just as a side note, TSR assumes that all dividends are reinvested without friction, right? No taxes, no transaction costs, which by definition means that not all shareholders can earn TSRs, right? Because if someone has to buy additional shares, someone has to sell them. Mm-hmm. So if you break down TSR, you can do it in sort of 2 big components. The first is price appreciation, and the second is dividends. And let's just leave aside dividends for a moment. We'll come back to that in a moment. So price appreciation, by definition, is going to be earnings per share growth times change in your price earnings multiple. We'll talk all about why multiples are limited, but for our purposes now, that's not too bad. And then earnings per share themselves are a function of net income and shares outstanding, right? So let's roll up our sleeves, right? When you think about net income, that's going to be EBIT, earnings before interest and taxes, minus financing costs and taxes to get to net income, right? And so what's interesting, by the way, just taking a step back, is since probably 1980, that middle item of financing costs and taxes have been basically on a downward slope. Now, it looks like with a new tax bill, if it gets passed, maybe the tax thing will be in steady state for a while, but already interest rates are up. So in the period that we looked at for the S&P 500, for instance, the net income growth was about 100 basis points higher than the EBIT growth because of that sort of tailwind from those things coming down.
Interesting.
The second piece is shares outstanding. And of course, companies issue shares and they retire shares. And by the way, just to set as a side note, in the cross section, you'd much prefer to buy companies. The companies that buy back stock do better than the companies that issue stock, but that's the basic story. Now, if you look at the S&P 500, we just have the data back to 2000, but it's all public companies since 2000. It's pretty interesting. They've issued about $10.3 trillion of equity, and they've retired about $14 trillion. So net, we've retired a little under $4 trillion. So, and by the way, that changes a lot by industry. Some industries increase, some industries go down. The last thing I'll say, by the way, is net income itself is net income growth is a very noisy series and a very mean reverting series. Okay, so that's sort of thinking about the price appreciation part. Now the PE part, I think, Greg, this will be close to your heart too. Like we're like, let's think about PE from a foundational point of view. And the way to think about that is Miller Modigliani wrote sort of the seminal paper on valuation in 1961. And they said you should think about multiples as two pieces. One is steady state, which is basically capitalizing earnings, inverse of that, and then basic not you take dollar of earnings capitalized by the cost of capital will give you that multiple, and then PVGO, future value creation, right, which is a function of how much you can invest at what spread for how long. And just to take a step back, over very long periods of time for the S&P 500, about 2/3 of the value is steady state, and about 1/3 is PVGO, sort of value creation on the come. But that vacillates from one place to another. And by the way, the other thing is ROICs and NPEs both regress. ROICs regress toward the cost of capital, Ps regress toward the steady state multiple. So you can sort of break down all those series in a very interesting fashion. Dividends, by the way, obviously we just looked at the ability and proclivity to pay dividends. About a third of public companies do that, but it gets a little complicated by share repurchases and so forth. So the value trap, just to sort of wind this up, is the idea that we're going to be attracted to low price earnings multiple stocks, right? And sometimes above average dividend stocks because they appear statistically cheap. But by contrast, if you break down this equation, if they're continuing to have their ROICs continue to decline or their capital allocation is foolhardy, then they're not going to be good. They're not going to deliver good TSR. So again, trying to keep all these issues sorted out and think about where companies may be able to do better versus where they're likely to do worse, I think is sort of the key to that whole report. So I just think many investment organizations and many actually corporate executives could sit around and say, if we want to have an attractive TSR over some period of time, they could break down the components just as we discussed, and then sort of think about or debate how they think they will unfold over the next few years.
That's interesting. So one side note on this, when I worked at Credit Suisse, I was in investment banking, so we were constantly going and pitching managements on different things. And for the number of times, in the middle of a statement, the banker would say, "And if we assume the multiple stays the same,"
right.
And I was always, "Why would we assume that? If we're suddenly just giving money back to shareholders instead of investing in the business, maybe the future growth value goes down, something like that." So,
100%. No, that's absolutely correct.
So you followed that up in April of 24 with a piece I really enjoyed: valuation multiples, what they miss, why they differ, and the link to fundamentals. You asserted that valuation multiples miss important information and they're getting worse. Why is this, and what should investors do to better understand valuation?
Yeah. So Greg, and you'll fully appreciate this. When I talk to my students, I say to them, you may absolutely use multiples, but you have to earn the right to use the multiple. And by that, I mean that if you use a multiple, 25 times earnings or 17 times EBITDA, whatever it is, that you understand the underlying economic implications that substantiate that multiple, right? So it's okay. So Aswath Damodaran, who's a great professor of finance at New York University and well known for his work on valuation, has argued that an analyst often price versus value companies. So pricing would be literally applying a multiple, either, as you said, vis-a-vis its history or versus some sort of comparables. Whereas valuing a business is taking the present value future cash flows, which requires a lot more work and thought and integrates other components of strategy and so on and so forth. And by the way, there's surveys of financial professionals supports this. 93% of financial professionals, when they're surveyed, say that they use a market multiples approach. So this really is sort of okay. So to your point, to your question, what do multiples miss, or what do earnings miss? Now, the first thing just to say, it's going to sound trivial, right? The two most popular multiples are price to earnings and enterprise value to EBITDA, right? So price is just the stock market capitalization divided by the earnings of the company. Enterprise value would be total equity plus total debt divided by EBITDA, which is a measure of gross cash flow. Okay, so in both cases, the numerator is reflecting a stream of cash flows from here to kingdom come. And the denominator is a snapshot, right, of either this year or maybe next year's earnings or EBITDA, right? So right away, we have this mismatch between something that's sort of perpetual versus something that's a snapshot. Second is there's no direct line of sight into the magnitude and return on investment, right? And you've already
Mhm.
pointed out how important that is.
Mhm.
Multiples don't really give you that direct line of sight. Now you can unpack it and discern it, but it's not going to be there because it's going to be some combination of growth and returns on capital.
Right.
But I think the really big issue is earnings, right? Specifically. And I think that the issue that's changed in my investment career specifically is the rise of intangibles.
Mhm.
So just to give all the listeners some sort of sense of this, in the 1970s, tangible investment was roughly double that of intangible investment. Intangible, by the way, just what it sounds like: factories, machines,
Mhm.
inventory. Intangible, also what it sounds like: something that's non-physical, so branding and software code and so forth. And that ratio is basically almost flipped all the way in
Mhm.
2025. So,
Yep.
one of your great guests was Anup Srivastava, right, professor of accounting, who's one of the leading experts in this, and he wrote a
Mhm.
paper which I thought was just terrific on this. And he said, let's look at what's a really important principle in accounting is called the matching principle, right? So you basically want to make sure your expenses match your revenues.
Mhm.
So he went back and looked at companies that listed in different decades, so the 60s and 70s and 80s and so forth, and just
Mhm.
looked at how good is cost of goods sold, which is typically directly linked to revenues, and sales general administrative costs, SG&A costs. And what
Mhm.
he found was COGS was actually pretty good throughout all the different cohorts, through all the different decades, but that SG&A has just, the degradation's been extraordinary, to the point where he said, today SG&A is practically unmatched to revenues, right? Which is an astounding comment for
Mhm.
an accounting professor, right? Specifically. So what is the solution? What is the issue? The issue is within, and I think you alluded to it, within SG&A, companies are making intangible investments, right? You think about
Mhm.
customer acquisition costs or branding. R&D is a good example too. And so the fix for this essentially is to capitalize, so put those investments on the balance sheet and then amortize them, just as we capitalize, for example, CapEx, and depreciate it over time.
Mhm.
Now, just
Mhm.
to give you some sense of this, there are a lot, the devil's in the details here. There are a lot of assumptions you have to make, but we used sort of an academic paper on this, and we did the numbers for Microsoft. And just to give the listener some sense of this, earnings end up being somewhere between 10 and 15% higher than what they're reported, and EBITDA is 35 to 45% higher. Now, that's sort of
Mhm.
the good news. That I don't know if it's bad news, but the bad news is, or the counterbalance is, that invested capital is much higher, right? So
Mhm.
it's showing that you're putting a lot more capital in the business. And then the last thing I'll say in this, this is like sort of a crowd pleaser, Greg. I
Mhm.
say to my students, I say something like, if you have a company with 100 million of EBITDA, do you care if it's 80 million EBIT and 20 million DA, or 20 million EBIT and 80 million DA? And everybody's like, yeah, I gotta care about that, right? And so it turns out, not surprisingly, more EBIT is better than less EBIT when you're thinking about that calculation. And in fact, there's a very strong correlation between that ratio of EBIT to DA and ROIC, probably not
Mhm.
surprisingly, right? And so the last thing I'll say, which I think is always fun, is that we show a chart. It turns out that price earnings multiples and EV to EBITDA multiples are pretty highly correlated. That sort of makes some sense.
Mhm.
But you can do some pretty fun stuff where you find two companies with the same PE but different EV to EBITDA multiples, or the same EV to EBITDA multiples and different PE multiples, and then sort of
Mhm.
examine why those things are different. And not surprisingly, it's the mix of investment, it's things like financial leverage, cash
Mhm.
holdings, so things that'll affect one of those items but not the other. So
Mhm.
I think when you put all this together, Greg, that I think people mostly price things, so they don't pay that much attention to it. But if you really want to be thoughtful, whether you're an executive trying to evaluate your own business or an investor trying to understand the value of a company, I think
Mhm.
you have to disentangle these key components to really understand the moving parts, and to figure out where they're going, basically.
Mhm. Mhm. Boy, that's really great. That was such a great explanation. I think a lot of people miss this. I mean, very often when we work with companies, we're not focused on investors. We're focused on companies. They'll complain we have the lowest multiple in the industry, and I think the sort of sequence of thinking you just went through is a great way to try to figure out why. There's usually a reason, or a collection of reasons. Just to move on, in our experience at Fortuna Advisors, we find many companies struggle with capital allocation. It's probably one of the biggest problems, including when they should invest versus distributing capital, whether they should invest acquisitively, organically, whether distribution should be via dividends or buybacks. These are big questions, and very often, sort of when we arrive at a new client, their rigor around how they make decisions is not that great, which is why the outcomes are not always really aligned with optimizing value creation. What guidance would you give boards and executives based on your years of research in the field of capital allocation?
Well, first thing I want to say, Greg, is I really appreciate you sort of taking a leadership role in exploring this issue of capital allocation. And by the way, I know
Thank you.
you're focused primarily on corporations, but as an investor, I always like to say all roads lead to capital allocation. So thank you for the work you've done on that and your leadership. I'll just take one step back and say it's really, just to be clear for the listeners, it's really about resource allocation. So, it includes human capital. So
Mhm.
I think I'm sure you agree with that. That's also a very important component. So we're going to talk mostly about capital allocation, the money, where
Mhm.
the money flows. But to your point, this is really important. Now, the first thing to say, and I think your experience would validate this, is that most executives are not trained to do this, right?
Mhm.
And they're probably not as proactive as they should be. So getting to become the CEO, where capital allocation becomes your prime responsibility, they don't necessarily know exactly how to do this. The guiding principle, just to state the obvious, is sort of the name of your podcast, right? Which is create more value, right? So thinking about value creation day in, day out. Now, kind of the way I think about this, and it may be wrong, is a little bit of a pecking order. So you're the CFO and you're sitting in a big swivel chair and you're evaluating opportunities that come before you. I would probably start with internal things, right? Why? Because we have better information, we have people on
Mhm.
the ground, and if you have good information systems, you should have a good sense of what's going on. So that would be things like capital expenditures, research and development, these intangible investments we've been talking about, working capital maybe in there. And then I
Mhm.
would probably then turn my attention to external things where it's mergers and acquisitions. And then once we've satisfied all our investment opportunities, then you think about returning capital to shareholders. So that would be
Mhm.
dividends, and we're not just shareholders, but all capital providers. So dividends, buybacks, and debt replacement. Now, I would just debt repayment. But I would just say that the answer to the answer to every capital allocation question is it depends, right? And it depends on price versus value, right? So, and it's
Mhm.
dynamic, right? So there's not one size fits all or one size in one situation versus another. Now, we try to keep track of this. I'll mention, there's a wonderful book by Will Thorndike written in 2012 called The Outsiders, which kind of chronicles, eight, I think, CEOs and how their path on capital allocation, how they did a great job, and it's really good. I mean, there's selection bias, right? Because obviously, by definition, he selected people that did a good job of this. And I
Mhm.
really wanted to step back and say, can we take a look at something from a larger point of view? So just empirically, it turns out, and these are sort of recent numbers by our reckoning, the biggest item historically has been mergers and acquisitions. Investment SG&A now, depends on the year, can be neck and neck with that. And then that's followed by CapEx, and then R&D from there. And then buybacks and dividends, which I'll put in a slightly different bucket. Our numbers are they're about $1.9 trillion in 2024. So M&A last year was $1.4 trillion, CapEx $1.5 trillion. So those are the items. Now M&A we might even spend a little bit more time on because M&A is probably the most it's the biggest thing that companies do. It's usually externally focused, and often executives are looking at the wrong metrics to discern whether that's a good investment or not. So M&A itself is almost is a very interesting bucket. My
Mhm.
guess, if you ask me to rank them, is I think CapEx probably has the highest returns on investment historically. R&D is a fascinating one. It's different for different industries, but that's been drifting lower in recent decades. Maybe that'll turn around. Intangibles has been relatively high. And as we know, M&A, if you want to be generous, it's been sort of value neutral, but
Mhm.
many companies struggle with that. Now, the other thing I'll just say, going back to returning capital to shareholders, I find I just, for whatever reason, I think both dividends and buybacks are really misunderstood by a lot
Mhm.
of people in the financial community. On buybacks, for instance, there's this concept called the free dividends fallacy. It's a great paper by Hartz, Mark, and Solomon on this, where people somehow think that dividends are free. I guess it's mental accounting, right? But they don't understand the fact that companies go ex dividend, right? If your stock's at 100 and they're going to pay $3 dividend, what you get is $97 stock and $3 in dividends. They're returning capital to you, right? It's not.
Mhm. Mhm.
So people have this mental accounting thinking the dividends are somehow free. And then for the heck, I just cannot not read this line from Warren Buffett. This is great. This is about buybacks. He says, when you are told that all repurchases are harmful to shareholders or a country or particularly beneficial to CEOs, you are listening either to an economic illiterate or a silver tongued demagogue. characters that are not mutually exclusive, right? So somehow, like, there's been this pillaging of buybacks. I think people literally don't understand what what buybacks do. I will say one more comment on the buybacks versus dividends. We show in one of our pieces that under very constrictive set of assumptions, they're mathematically identical. They're certainly in the same mental, sort of category, but executives think about them totally differently. And I'm sure, Greg, your experience probably validates this, which is dividends are a little bit like CapEx and a little bit like R&D. They're kind of sacred. They're kind of sacred, right? Like we want to always make sure that our dividend stays, usually tends to grow over time and so forth. And versus buybacks, we're sort of like, hey, we paid all our bills, we got some money sitting around, like, let's go buy back our stock. So it's a very interesting, and that's validated by the standard deviation of growth rates. The standard deviation of growth rates of dividends is very, very narrow, so they tend to plod forward. Whereas buybacks, they tend to be much more pro-cyclical. They tend to follow the market to a greater degree. So anyway, I just think this is a topic that it's really interesting. The first day you become CEO, probably the first thing you should do is read up and think about capital allocation, perhaps surround yourself with folks who can be helpful in helping you do that, because it's extraordinarily important.
Yeah, just to comment on the Thorndike book, just as a note. We were both involved in a roundtable on capital allocation probably a decade ago. That was inspired by that book. Actually, that roundtable we created that roundtable because of the book. It's a great book. Highly recommend it. And on your comment about buybacks and your quote of Warren Buffett, I've been accused of being a sort of a downer on buybacks over time, because I criticize how a lot of people do them, because they tend to buy back more shares when the price is really high than they do when the price is really low, and that for the remaining shareholders, that's bad for them, obviously. But I also co-authored an article with my colleague Michael Chu called "Save the Buyback, Save Jobs." Because it's really important for companies that are unable to redeploy capital to have a means of distributing it. And dividends, because of the sort of steadiness with which people view them, doesn't always allow you to distribute all the cash. So I think they play a really good role in redistributing, capital from companies that can't use it to companies that can. And it's, I think, one of the reasons why the U.S. Market over the long term has done so much better than a lot of other markets, because that redistribution is very active. And just one more comment on this. The dividend point, and this is not from research, this is from just anecdotal conversations I've had with executives for over 30 years. The one argument about dividends is the information content of it conveys confidence in the market, and that's true. But what I've seen, more times than I have fingers on my hands, are executives that say, "Ooh, we've got a problem in our earnings report. Let's increase the dividend to make up for it." And all of a sudden, it's the opposite of conveying confidence. We're using it to try to convey we're artificially confident when we actually shouldn't be. And so I think that's one of the reasons why the signals are not always as good as people would like to see on some of these things.
Yeah, that's a super interesting point. But I just to underscore your point on redistribution of capital, this is really an essential component of a free market system, and I think people often overlook that. And again, for some reason, I think people think the buybacks are just there to enrich the executives, not acknowledging that most stock is held by non-executives. But anyway, that's fine.
So now I'll turn to the most important things to me. So and you wrote about it last year in a piece called "Measuring the Moat: Assessing the Magnitude and Sustainability of Value Creation." And it relates sort of back to the multiples discussion, but it's an area of particular interest to me because far too many leaders, corporate leaders, especially finance leaders, seem to forget that sustainable competitive advantages are what allow you to earn sustained returns above the cost of capital, which is where value comes from. They sometimes cut costs that improve short-term earnings but reduce the moat. Can you please just share with investors how they can assess the moat, and with managements what they can do to strengthen their moat?
Yes, here again, Greg, I just applaud your emphasis on this point. I think more executives should be very explicit about it. And, so just to underscore what you're saying, sustainable value creation is sort of the key to a lot of this stuff we're talking about. Now, the first thing I'll just say is just empirically, and the most recent version of Measuring the Moat, we try to do a lot of empirical work just to substantiate and give people some contrasts. But one example I think stands out is if you study industries, so you just do whatever, 50 industries or 60 industries, what you'll find in every single industry is there are value creating companies, value neutral companies, and value destroying companies, right? So the great industries, they lean toward value creators, but they're value destroyers. The bad industries, they lean toward value destroyers, but they're value creators, right? So right away, we know that strategy matters, right? We know that some companies are differentiating themselves in some important way that allows them to generate high returns. So very much your point. And by the way, the valuations, not surprisingly, tend to follow that quite closely. So what we try to do is lay out an assessment for this, and we try to give people literally like a checklist to walk through this. The first part is what we call lay of the land. So we do things like industry maps. So this is just sort of mapping out the economic interactions. Profit pools, which is using some sort of an economic profit measure to say like where is the profit happening along the supply chain. Interestingly, companies like Apple are fascinating to study in this regard, right? Because a lot of they have a lot of the value creating activities under their umbrella, which is design and marketing and distribution. And they tend to outsource a lot of the value neutral activities, which is assembly. So it's almost this brilliant thing if you follow the product all the way through, like who accrues the value. We do a lot on market share instability. So the premise there being that it's really hard to sort of be king of the hill if the market shares are moving around a lot, whereas if markets are more stable, the market shares are stable. And then we go to industry structure. Here we just do classic Michael Porter's 5 forces. I think if applied intelligently, those can still be very insightful. And think about barriers to protect incumbents. So if you are the incumbent, what does that mean? We spend time on disruptive innovation, Clay Christensen's work. I think today, when we think about the role of artificial intelligence, for instance, this is going to be really important. Is it in Christensen's parlance? Is this a sustaining innovation that allows the strong to stay strong or get stronger? Or is this a disruptive innovation where the giants can be taken out at the knees? And then we lastly focus on firm-specific advantages, which is really just value chains. And so I like to say, if you believe your company is going to have a high ROIC or a growing ROIC and sustainable, you should be able to point very specifically to the variables that are behind that. The last thing I'll just mention as a catch-all is that, government interaction these days is more important than ever. And so something to bear in mind. Now, you made a comment, Greg, about cutting costs, as a way to generate value. So I have to say that I've been very enamored in the last decade or so with this idea. It's a value creation model, and it's typically called the value stick. And it was developed by Anna Brandenburger and Harborne Stewart. So Brandenburger and Stewart model. It was popularized by Felix Oberholzer G, who wrote a book called Better, Simpler Strategy, which I would recommend. And so the value stick, let me just try to do this very quickly in a nutshell, right? There are 4 basic points that are important. One is called willingness to pay, which is what is the customer willing to pay for a good or service? We can all relate this because you walk around a store and you sort of know the limit of something you're willing to pay. Then there's price, right? And if the price is below willingness to pay, that's consumer surplus, right? So anytime you feel like you've gotten a good deal, right, that's because price is below willingness to pay. Then there's cost, right, of the company, and then there's willingness to sell or willingness to supply, right? So the value creation from the company's point of view is price minus cost, right? But we have this bigger thing from willingness to pay to willingness to sell. Now, Warren Buffett has said before, like the indication of a great business is pricing power, right? So the ability to raise price. But I'm reoriented on this very much. So Jeff Bezos' last shareholder was, he had a tagline, which is very familiar to you guys, which is create more than you consume. So that means increasing willingness to pay and reducing willingness to supply. And so to me, this is the key thing now. Companies I know want to play with that cost lever, but really I think the emphasis strategically should be increasing willingness to pay or lowering willingness to cost. So how do we do that very quickly? Increasing willingness to pay would be tapping, if available, network effects. It would be focusing on how you reduce the cost of your complements, or be offering a good or service that people value at a premium, right? And then lowering willingness to supply, which would be lowering your supply costs, often through data sharing, for instance, focusing on productivity. So productivity is related to cost cuts, but needn't be exactly the same thing. And then finally, and I think by far the most important thing, the number one cost for most corporations are their employees, and creating great employee relationships, I think, is really the key to doing that. So I think that every company, these ideas should be joined at the hip, like value creation and strategy. They obviously go completely together. We tend to teach them separately, interestingly. And I think a lot of, there's a finance department and a strategy department they're kind of operating. I mean, they're near each other, but not exactly. But really, these things should be completely intimately intertwined with one another.
Yeah, I think that's a great description. I mean, when I first meet new CFOs that I don't know previously, I often ask them, you know, so what is your most important competitive advantage, or why is your multiple higher than your peers? Things like that. And I think a lot of them just don't think through their answers to questions like that enough. And I think your point about bringing strategy and finance together so that they cooperate more is, I think, an important part of it. I think the most lacking skill in CFOs that I've witnessed over time, and it's not lacking in many of them. I'm not trying to say they're all like this, but the ones the less a CFO really understands strategy and how it influences those competitive advantages, the less likely they are to be a really effective CFO. I think
So Greg,
that
I'll
is
just
particularly
tack,
important for them.
I'll tack in, I'll just add in that every semester I bring in an executive to my course and we talk about sustainable competitive advantage. So literally the executive talks for 3 hours and
Mm-hmm.
students write a paper. Does this company have a competitive advantage? And even with CEOs, we have a combination of CEOs and CFOs, but even with CEOs, they struggle to get it right because they're going to talk a lot about tactics.
Mm-hmm.
They'll talk about sort of like the high level stuff, but they don't really ground it in sort of
Mm-hmm.
some good theories. So it's a very your I think your observation's spot on. And
Mm-hmm.
again, successful businesses tend to be successful whether or not you identify why it's successful. But it's nice to be able to put your finger on it to some degree, I believe. So
Mm-hmm. So let me go down a very different road here. So, with the explosion of ETFs, many of them simply tracking indices, is there a risk that the market becomes less efficient? In other words, with fewer people actually picking stocks, which of course drives prices. Will prices tend to deviate more from intrinsic value, or we're going to lose some of the efficiency of the market, if you will?
this is a fascinating topic. And by the way, it's also a hot area of research in academia. I think, Greg, if you want to pick someone that argues that markets are less efficient, you can find a few academics that would papers that would point that out. And if you
Mm-hmm.
want to say that nothing's changed, you can find a bunch of academics to point that out too. So I think it's an unsettled issue. Just to be super clear, you said it, but just to be crystal clear that active managers cannot go away ever because they do two things that are really important. One is price discovery, which is the fancy way of saying you make prices efficient, and the
Mm-hmm.
second is liquidity, which we also don't want to forget. So, you have to pay, you have to have a bill or have to pay college tuition. You want to be able to get liquidity to be able to do that.
Mm-hmm.
I'll just say that my overall inclination on this is to say that on balance, markets are not less efficient. I mean, historically, in any endeavor that you can think of, whether it's business or athletics, we tend to be grinding toward better, right? We tend to be,
Mm-hmm.
athletes today are better than a generation or two before. Businesses today produce better goods and services than generations or two before. And by the way, competition and just the larger world sort of ensures that's the case. So
Mm-hmm.
my overall inclination is to say no to this. But that said, I mean, very prominent investors, Cliff Asness at AQR, wrote a paper called The Less Efficient Hypothesis, right? So suggesting possibly things like social media could lead to these sort of inefficiencies. Seth Klarman, right, Baupost, one of the great value investors in the last 30 years, also has made similar comments. So I think it's something we need to monitor and understand. My inclination is, as long as we have some percentage of the population which is active, and obviously indexing or ETFs have gotten to be big, but it's still a majority actively managed. But clearly, active management is going to be under pressure for a long time. So it's hard to say. Now, last thing I'll just say from a company's point of view, this is really important, right? Because from a company's point of view, as you pointed out, you should have a view of where your stock should be based on the fundamentals as you see them, right? Because
Mm-hmm.
you have asymmetric information. If you feel your stock is overvalued or undervalued, probably line one of is communication with your shareholders, right?
Mm-hmm.
Hey, you guys, you think your stock's undervalued, you're getting the margins wrong or the growth rates wrong, and just communicating that way. And by the way, it doesn't have to be formal; it can be less formal. Or if your stock is over. But the second line of action is to do something about it, right? So if you think your stock's overvalued, you sell it, right? You issue
Mm-hmm.
equity. If you think your
Mm-hmm.
stock's undervalued, you buy it back, right?
Mm-hmm.
To your point, maybe not all companies are great at that, or maybe they don't have perfect timing on those things. But broadly speaking, if you have a strong and grounded view that your stock's undervalued, buying back stock is going to be a good thing for you, right?
Mm-hmm.
So I think this in some ways executives should take this as they should probably default to assume that the markets are pretty good,
Mm-hmm.
but if they believe the market's off and they have a good reason to good reason for that, then they can actually take some action after communication. They can take some actions that could enhance the value for ongoing shareholders.
Mhm. Yeah, they should buy low and sell high. Um,
Which is what all capital allocation is at the end of the day, right? Everything else a detail. Everything else.
exactly, exactly. So let's to wrap up. You've been close friends and a co-author with Al Rappaport, another one of the great minds in the field. I attended a multi-day seminar with Al in the early '90s, and it was superb. He had a huge impact on the fact that I'm in this career. Really great guy. What can you share about Al and his contributions to the field?
It's hard to say enough, Greg, honestly. And Al just recently celebrated his 93rd birthday. He's extraordinary, still very engaged mind. We have a lot of really fascinating and fun conversations about a lot of the topics you and I are talking about. I'll just say, it's gratifying to hear that he had an impact on you. I would just tell you the impact he had on me is transformational, right? So I joined an investment banking training program in the mid 1980s, and I was not a business major, and so I didn't really know the terminology and so forth. And just by pure happenstance, one of my colleagues in my training program gave me a copy of Creating Shareholder Value in 1987. That was Al's first big book. It was transformational. I read that and it completely made sense. Pieces clicked into place that hadn't been there before.
Hmm.
I'll just say for all the listeners, there were three lessons from Creating Shareholder Value that to this day remain at the center of, and it's a lot of the stuff we've been talking about today, right? Number one is cash flows are more important than earnings.
Hmm.
And an undue fixation on earnings and earnings per share, which I think a lot of executives to this day have, can be very problematic. Let's give two examples. One is executives feel that M&A deals that are accretive to EPS are good. And what we know empirically is that there are lots of deals that are EPS accretive and value destructive. And you can do the math to show why that's the case. Another one is, the motivation to buy back stock. It may not be, we think the stock's undervalued. It might be, gee, we don't want our share count to go up a lot. It's embarrassing. So they buy back stock to offset that. The second lesson I think is even more fundamental, which is that strategy and valuation have to go together, right? So in other words, you can't do an intelligent valuation without understanding the competitive positioning and prospects of a company.
Hmm.
And likewise, the litmus test of a thoughtful strategy is that it creates value, right? That is
Yep.
an NPV positive thing. And I think we confuse a lot with tactics and strategies and all this kind of stuff. But bringing those two things together in one way is really
Hmm.
important. I think it's the rare company and the rare investor who does that as skillfully as he or she should. And then the third point is, it was chapter 7 of the original book. It was called Stock Market Signals to Managers. And by the way, Greg, as you know, his first book was aimed at your audience primarily, which is corporate executives. And his point
Hmm.
was,
Hmm.
hey, you just think you're investing above your cost of capital and all's good. It's like, no, not really, because if the stock market expects that, then your stock's going to earn the cost of equity, not better. You actually have to meet
Hmm.
or exceed what's already priced in. So that means
Hmm.
A, you have to understand what's priced in, and then B, think about can we or should we, how can we do better than the expectation? So to state the obvious, when I read that, and I was coming at it from an investor point of view, I'm like, this is the exact opposite of the same coin, right? We can use these exact same tools and techniques to think about it from an investor's point of view. So
Hmm.
I embrace that from an investor's point of view right away. And I would just say, like creating shareholder value, I think you probably would share the sentiment. This idea of expectations, when you say it to people, is mom and apple pie. I hope it makes complete
Hmm.
sense. Yet very, very few people actually operate this way, right?
Hmm.
The tendency is still, I think earnings will be $2. I think the PE should be 25. So therefore it's worth 50. And then
Hmm.
let's compare the stock price to 50 versus saying, if the stock's at 40, what do I have to believe about future states of the world to justify today's stock price, right? And I think
Right.
executives should have that same view. So
Yep.
as you pointed out, I met him in 1991. We started collaborating. Our first book was Expectations Investing
Hmm.
version 1, which unfortunately came out September 10th, 2001. So it was a day before a national tragedy and, the middle of a bear market. We updated that book 20 years later, but we've collaborated on lots of other articles and things in the interim, including things related to corporate governance. We also collaborated with Al's former student, former CEO of Baxter International, Harry Kramer, who's now a very popular professor at Kellogg School of Management at Northwestern. And so that's been super fun. The other thing I'll just say now, taking a step, not so much the personal, Don Chu, who I think has also been one of your guests, wrote a
Mhm.
wonderful book called The Making of Modern Corporate Finance, where
Mhm.
he talks about how much better off we are today than we were, say, 50 years ago because of many of the advancements in corporate finance. When you think about the whole value creation movement, there probably were two folks you'd point to. One would be Joel Stern from Stern Stewart,
Mhm.
who himself, was a University of Chicago product and very much reflected that University of Chicago view, to
Mhm.
which, by the way, I'm very sympathetic. I would say that Stern, for me at least, and I would appreciate the work he did, but was a very financy type of guy. What I always appreciate about Rappaport is it got to many of the same principles, but vastly more holistic. So
Mhm.
he really was early in embracing and integrating the strategy work. As you pointed out, like he did strategic financial planning, which was one of
Mhm.
his very popular sessions at Kellogg. Merger Week was epic. He did a thing called Merger Week, which was the place to be if you were a CFO learning how to do mergers and acquisitions. So I just think that his imprint on this whole movement, if you want to call it the modern corporate finance, has been extraordinarily powerful. I
Mhm.
would say that I guess the last thing I would say is that, and you maybe see this in your companies, there's been a sort of a quiet backlash against creating shareholder value.
Mhm.
That somehow it's tantamount to boosting your stock price, or like you said, communicating maybe in a fashion that is flattering to your company.
Mhm.
Whereas if you go back to the core of creating shareholder value, and obviously I'm hanging out with the father of this concept, it's really about long-term value creation. And
Mhm.
long-term value creation is, as you pointed out, like it's doing the right things today to sustain or extend my moat. It's taking care of all the stakeholders. It's not trying to take advantage of any of my stakeholders, because I know that I'm going to be around over the long haul. I want my stakeholders to do well. I want them to thrive, actually.
Mhm.
That's this build more than, create more than you consume type of concept. And so I think we need to go back to what creating shareholder value is all about, which is doing the right thing, thinking long term, but by the same token, also understanding the fundamental components of value creation. So I think his contribution in that whole
Mhm.
discussion, sometimes it gets obscured, but he's been right on, very on point for this for north of 50 years on this basic
Mhm.
point. And I hope we continue to gravitate toward embracing that full message.
Boy, what a great way to finish our conversation. Al's a great guy, and that was a great tribute to him. So, thank you. So, we've been speaking with Michael Mauboussin. Thank you, Michael, for joining us for this very important conversation.
Thanks, Greg. It's been a delight chatting with you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.